Hello and welcome to this special interview here on Money Paathshaala. Joining me today is one of the smartest people in the mutual fund industry. Looks very young, but 20 years of experience behind him, very fitness conscious, a role model for a lot of young people who are doing well professionally at a young age as well. Akhil Chaturvedi, who's the director and chief business officer at Motilal Oswal Asset Management Company, but has worked with other mutual funds as well during this 20-year period, so carries a lot of rich experience. Thank you very much, Akhil. It's always a pleasure talking to you. My first question, a lot of investors one speaks to or sees the commentary, they seem to be getting kind of tired about the fact that for 2 years, this market hasn't really moved anywhere significantly. It's been largely flat if you look at Sensex to Sensex. Now, we've always been saying that, the nature of equities is actually that. But then the ground reality is people then say, and then simultaneously, and I'll talk about that a little bit more when it comes to asset allocation, simultaneously they see other asset classes doing well. And so what is your own experience? You've been, traveling, you've been hitting the ground, interacting with investors. You have your own investors. What's the kind of sense you're getting? Are people getting impatient?
Yes, Vivek, thank you first of all for all the good words about me. Thank you so much. So this is a very, very important question, Vivek. Certainly when investors come into equities with a lot of conviction, and this happens generally when the markets are very, very exciting and the markets are in a bullish mode. That is the time we see a lot of excitement in the investors and a lot of flows come in those times. And often after good times there are bad times, and after bad times there are good times, right? So this is all about market cycles. What we have seen in the near recent past is that those who have come in the period 18 months or thereabouts, there is some amount of dissatisfaction, there is some amount of curiosity that when will they make returns, because at this stage they would be sitting on 0 to 5% kind of a band, not lost money, but not made equal to or higher than fixed income returns. So to that extent, there is a little bit of anxiety. But certainly, last time also we discussed this, that the maturity level of the investors certainly has improved or has gone up. So while they are impatient, but it's not reached a stage where they cut loss and move out. So we have not seen a spike in redemptions and people stopping their SIPs or people moving out lock, stock and barrel, because the numbers are visible month on month. The SIP numbers are moving up. Lump sum sales are also moving up. As a category, equity assets have gone up. So we see the trend with a lot of maturity in the investors who have come, let's say, a year and a half back. And we continue to see new investors also selectively come inside. The velocity of inflows could be different, as I said, from different cycle perspective, but it is still positive. So in the recent past, certainly Indian investors have come off time. But to your channel, I just want to explain to all investors, and I am also investor, you are also investor. In 23 years of my experience in equity markets and working with mutual funds, we always talk about investing in equities with long term, and we never define long term. Now, why do we say, you, me, newspapers, articles, best of the best, and everybody will say come into equities for long term. Now, long term, why we say is that typically we don't know that which years the market cycles will be positive and which years the market cycle will be negative, or which years the market cycles can be sideways. Like Ramdev once said that one long term is equal to average of good times, bad times, and neutral times, right? So when you live through all these cycles is where you make the average of 12 to 15%, right? So coming into markets in good times and expecting good times to continue thereafter generally doesn't happen. So irrespective, when you come in a good time or you come in a bad time or you come in a neutral time, once you cross through 2-3 cycles of ups and downs is when you will reach an average of 12 to 15%. Usually this happens in a 10-year plus kind of a time horizon. But timing the market that I will come now and I will go then, that generally doesn't work. And the biggest hedge to making a 12 to 15% return in equities is long term. Typically, the long term should be 10 years plus plus. So I would say 10 years should be a starting point. After 10 years, you are very comfortable that your principal will be broadly protected. You should not be sitting on drawdowns, and you would be on reasonable compounding in terms of your average return. So that is why we say always that long term. Now, just one example, if I have to give you, from 2014, when the Indian market started to do very well. So from 2014 to 2023, now we are okay. There are only 3 years which have been positive.
Oh.
And if you have been absent in those 3 years, your return is FD return. So 2014-15 was good, 2017 was good, and 2021 was good. Rest 5 years were all flat negative. 15 we went through correction, 16 was flat, 17 we went up, 18 we went down after the introduction of long-term gains, ILFS crisis, GST, demon, all these things. Then 2020 COVID happened. 2021 we saw a fantastic rally, and since 22 we are in a flattish kind of environment. So now, if you have been a investor since 2014 till today, you are sitting on a good compounding of 13-14%. But that is if you have been there in those 3 good years, and also in the bad years, yet you have made your 12 to 15%, right? So I hope you understand what I'm trying to say.
Yes,
that
yes. In fact, it's very interesting, Akhil, that I think in a lot of the communication for the last, whatever, 15, 20 years, I think uh, a lot of people were saying equity is 3 to 5 years. And I'm very glad that you're pushing that number now to 10 years and beyond, because I think, the way markets are evolving, 3 to 5 years perhaps is not long term anymore to ride that whole cycle, as
yes,
you very nicely
yes,
explained.
yes,
And I think that clarity is very important when anyone enters equity. My next question, you've been an equity-centric mutual fund house from the very beginning. And however, when a new investor, any young person who's listening to you wants to enter, and of course, we've seen the whole debate around debt funds. We saw the tax incentive going away. And then there is this debate that should you still invest in a debt fund, or should you go into a balanced fund, which gives you a bit of debt and equity? So I'll keep that debate aside for now. But for a new investor at this point, uh, what, according to you, would be a good category to start with?
If I get your question right, if this is for absolute virgin investor, first time coming into
Yes.
equity mutual funds, then large caps clearly is the best way to start with. Buy into one amongst several good large cap products. You can also start with a Nifty 50 index fund, but if you want to come in for outperformance and alpha, then come into one or two good large cap funds where 65% and more is invested into the top 100 companies. Essentially, what will happen is that you are buying into India's most pristine blue chip companies, which have been in business for several decades. They have a great track record, very solid, proven ownership and management, sustainable growth, and generally these stocks are relatively lesser volatile. They fall less and they grow at a reasonable good pace. So for first time investors, the first thing to consider is that you should protect your capital. This is very, very important. So to protect the capital, you come into companies which are relatively less volatile, which will typically be the large cap businesses, and expect a 10-12% kind of a return profile over a longer term period. Like I said, you should look at 10 years, but for large caps, I would give it to you that, okay, give it a 5-year period, right? So for large caps, maybe 5 years is fine, but that is a good starting point. And Maybe in due course of time, then you can move into a flexi cap fund where you get some exposure to mid cap and small cap, and then you take your journey forward as you get your experience.
Akhil, there has been we've seen simultaneously while we've been talking about equity, we've seen gold, seeing a significant rise. We've seen real estate in some kind of a bull run. And these are both asset classes which Indians have always preferred over the years. Now, again, one sees a trend. Oh, gold is doing so well. Why should I go and try some other asset class? I understand this asset class, or real estate is doing well. And as you rightly said, that there'll always be time horizons where one asset class will do really well, and another may not. And that brings me to the question on the importance of asset allocation. And I know that I've probably asked you this dozens of times, but since every day we have new investors coming in, it's important to reiterate it.
Yeah, Vivek. So, see, asset allocation is the essence, or what do you say, the center of gravity to the entire financial planning process. And it's a very deep subject, often spoken a lot, but practiced very, very little, right? So, extremely important for every investor to uh, first understand their goals in life, how important money is, what kind of money they need at what intervals. Once this is clearly defined, then it becomes life easy to do asset allocation, right? Because for your short term, medium term goals, you will have a different asset allocation. For your long term goals, you will have different allocation. But if I have to give a simplistic answer, then asset allocation is very important. One should definitely have something of everything. I would not say that you should be biased towards equities or biased towards debt or biased towards gold. Try and have a combination of each asset class. For a moment, I'm keeping real estate away because real estate generally will be the house you live in, and it's an expense item. So it is not a investment, right? Once you have bought, you are stuck. Nothing happens unless you are trying to buy a second home for rental income, etc. So we'll stick to three asset classes: gold, fixed income, and equities. Now, the allocation in each of these asset class will depend on your short-term, medium-term, long-term goals. To make your life easy, what I can suggest is that all your planned expenses for, whether it is buying a car, whether it is trying to accumulate your principal contribution for buying a home, or whether it is education, whatever it may be, which are the expenses you are likely to incur in the next 5-year time frame. Those monies you keep on the side with a higher allocation towards maybe gold or fixed income. But once you have planned for your key expenses, your key goals, anything which is left after that should go in 100% equities for a long term without any cap of 5 years, 7 year, 10 years. So if you can decide your equity allocation basis that you don't need this money for the next 5 years and for these purposes, then you're clear that your equity allocation, whether it is 10%, 20, 30, 40, 50, whatever it may be. So you have done your equity part. Now the balance, fixed income and gold, thumb rule, I would say 10-15% gold at all times, and rest you do your fixed deposits or you do your fixed income funds. For that you can get guidance from your financial advisor, etc. But typically equity, gold, fixed income, 10-15% gold at all times. Equity once you have provided for all your short term, medium term goals, so that your equity is a allocation which you allow it, because equity is all about compounding. So compounding works only with time. So you give it 10, 15, 20, 30 years and let it compound, and that will become your large pool of wealth for your long term goals like retirement, like child marriage, like future foreign education, etc. And so that is, you have done that part. And short medium term goals you are protecting to your cash, your debt, and your gold. So it's a very simplistic way of putting it, but it needs a lot of work, and you need professionals to guide you in detail to help you reach your goals. And I would also say that apart from your financial planning, Risk management is also extremely important. So do provide, we have all been through COVID and we have seen the trouble people have gone through in the cost managing. So insurance is also extremely important, life insurance, medical, all of these things have to be planned through a professional, and then it has to be followed up on a regular basis. But it's a very, very serious subject and needs a lot of time to discuss the various aspects.
Look forward to many more conversations with you, Akhil. Thank you very much for coming by here on Money Paathshaala, and I wish you all the very best. Keep doing the great work that you have been doing for 23 years, and thank you very much once again.
Thank you, Vivek. Pleasure talking to you. Thank you so much.
Thank you.